Have you ever wondered why most traders fail, even when they have the right strategy? It's not always the market. It's often their risk management. In today's video, we're diving deep into one of the most important concepts in trading, risk management. If you don't understand this, your trading career won't last long. Risk management in trading is the process of identifying, analyzing, and controlling the potential losses you might face in a trade. It's not just about avoiding losses, because losses will happen. It's about limiting them and making sure they don't destroy your account. Think of it like this. If your trading account is your army, then risk management is your defense system. No matter how powerful your attack is, your strategy, if your defense is weak, you will lose the war. Let's be honest, the majority of traders blow their accounts. Why? Not because they don't know how to trade. But because they risk too much on a single trade. They chase losses, or they trade emotionally. Even a winning strategy can fail without proper risk control. Here's a hard truth. You can have a 70% win rate and still lose money. And you can have a 40% win rate and still make consistent profit if your risk is managed properly. There are several key elements every trader must understand. One, risk per trade. How much of your account are you risking on each trade? Pro traders usually risk 1% or less. Two, risk to reward ratio, RR. If you're risking $100, are you aiming to make $200? That's a 1 to 2 ratio. We'll cover this in full in episode 2. 3, stop-loss placement. Where do you exit when the trade goes wrong? No stop-loss equals gambling, not trading. 4. Position sizing. You need to calculate the correct lot size, or number of shares, based on your stop loss and account size. Five, managing drawdown. What happens when you hit a losing streak? Can you survive 5 to 10 losses in a row? Risk management ensures you can. Example 1. No risk management. John has a $1,000 account. He risks $200 per trade, 20%. He wins 2 trades, gains $400. Then he loses 3 trades, loses $600. Account down to $800, and his psychology is broken. Example 2. With risk management. Sarah has a $1,000 account. She risks 1%, $10 per trade. Even after 5 losses, she's only down $50. She can keep trading and stay calm because she has a system. Moral: it's not about how much you can win. It's about how long you can stay in the game. New traders often chase excitement, big trades, fast profits. But pro traders chase survival and consistency. Risk management may sound boring, but it's the difference between a gambler and a consistently profitable trader. So let's recap. Risk management protects your capital. It keeps your losses small and survivable. It's the foundation of any long-term trading success. If you want to grow as a trader, start managing your risk like a pro. In the next episode, we'll break down the risk-to-reward ratio and how to find the best setups based on it. Don't forget to like, subscribe, and turn on notifications, because this series will change the way you trade forever.